Most retail traders start out by loading their screens with as many tools as they can find. They end up layering on overlapping lines, moving averages, and complex algorithms until the actual price is barely visible. The problem with these popular indicators is that they are mathematically designed to be lagging. They take past price movements, run them through a formula, and spit out an average of what has already happened. Professional traders operating at the highest levels of finance cannot wait for historical averages. They need real-time, unfiltered data to make immediate decisions when capital is on the line. Waiting for a delayed mathematical signal creates a fatal lag in execution. By the time the indicator tells you to buy, the opportunity is often already gone. The solution is to strip the chart bare of the lagging math and focus exclusively on pure price movement. This is price action. It is the direct, unfiltered language of human market psychology, showing you exactly what buyers and sellers are doing in real time. To actually read this language, we have to decode 4 sequential concepts. We start by analyzing the absolute smallest unit of data on the board, and then build our way up to the macro architecture of an entire trend. True market visibility requires removing the clutter and isolating the pure signal. We start our analysis by zooming all the way into a single candlestick. Every single candle records 4 exact data points for its specific time frame. The highest price reached, the lowest price reached, where the period opened, and where it finally closed. While the candle is forming, those wicks and the fluctuating body represent a localized real-time war. Buyers push the price up, sellers slam it down, and the final shape is simply the footprint of whoever won that specific battle. Every major market movement begins right here, at this atomic level of market psychology. When we shift our perspective outward, we can see how these individual victories chain together over time. If buyers continuously defeat sellers period after period, the resulting velocity creates market momentum. You are watching capital rapidly pour into a specific direction. You can spot this acceleration clearly on a chart. Instead of small, indecisive candles moving sideways in a stagnant range, you get large consecutive bodies stacking rapidly at a steep angle. Momentum leaves a visual footprint of institutional control. It shows exactly where the heavy volume is driving the market. But momentum has a physical constraint. No market trend can maintain a straight, aggressive vertical line forever. Every asset has a historical average price that acts like an invisible center of gravity. When aggressive momentum pulls the price too far too fast, the tension builds. This triggers mean reversion. The buyers become exhausted, momentum stalls, and the price violently snaps back towards its historical average to relieve the pressure. Understanding how to spot this elastic limit prevents you from making the classic mistake of buying at the absolute peak of an overstretched trend right before it collapses. This creates a critical mechanical question. When that price snaps back during a mean reversion, where does it find a floor before the trend resumes? We can map those exact stopping points using Fibonacci retracements, a mathematical grid based on ratios that recur throughout data and nature. When thousands of algorithmic systems and institutional traders all use these same coordinates to time their entries, it creates a concentration of buy orders that physically halts a falling price. Because the market respects these specific mathematical pullbacks, a trader can identify exactly where a correction is likely to end and where the primary trend will resume. From this perspective, the separate elements interact in a single sequence. Localized candles build into aggressive momentum. The price stretches until it hits its elastic limit, and the resulting reversion finds a floor at the Fibonacci grid. Compare this logic-driven view to the overwhelming tangled mass of lagging indicators we started with. Stacking these 4 secrets changes the objective of a trade. Instead of waiting for lagging lines to cross after a move happens, you identify structural pivot zones before the price reaches them. You realize that the ultimate uncorrupted financial indicator is the raw price itself. Market mastery does not come from purchasing the most complex algorithm. It comes from learning to read the mechanical forces of human psychology as they unfold in real time.